everyone, it's Lauren Mack. Index funds are a great way to invest in the stock market and have a quickly diversified portfolio. There are literally index funds for almost anything. So how do you know which ones are best? It's always important when investing in index funds to determine what's in the fund, to review the returns, what's the minimum initial investment amount, as well as the expense ratios. I'm going to break down 6 index funds covering several different markets and indexes, and I'm going to explain why I think each one is the best. You'll want to stay to the end because the last fund has a super bonus that is pretty rare among index funds. I just want to make a quick disclaimer. I'm not a financial advisor. This is not financial advice. Before making any investment choices, you should always talk to your own financial advisor. Before I jump in, comment below. I want to know, do you prefer to invest in individual stocks or index funds? The first fund we're going to talk about is the Schwab S&P 500 Index Fund, ticker SWPPX. This fund is an official S&P index fund. This means that this fund investment tracks the total return of the S&P 500. This fund usually invests 80% of its assets in these stocks. This fund attempts to replicate the performance of the index by giving the same weight to a given stock as the index does. Another thing about this fund that makes it attractive to investors is that the expense ratio is very cheap at just 0.02%. In other words, 20 cents for every $1,000 you invest. This is probably one of the cheapest expense ratios you'll find for an S&P 500 index fund. Because the investment fee is so small, your returns can almost be identical to the performance of the S&P 500. The current dividend yield is 1.57%. The minimum initial investment is only $1. For the portion of my portfolio that I've invested in the S&P 500, it is in this fund. Please note, any returns or dividend yields mentioned are as of the day of the recording, so you should always double check them. The next fund we'll talk about is the Vanguard Growth ETF, and the ticker is VUG. This is the first ETF that we're going to talk about. An ETF trades more similarly to a stock. The Vanguard Growth ETF tracks the ECRSP US Large Cap Growth Index, which has a similar performance to the S&P 500 Growth Index. This fund invests in 255 US large cap growth stocks. Large cap companies are companies with a market capitalization of $10 billion or more. These companies tend to be more stable and risk adverse. When the market becomes rough, more people flock to large cap companies because they're more stable. This fund is made up of tech stocks, consumer discretionary stocks, industrial stocks, as well as energy and utility stocks. Tech stocks make up almost half of this portfolio. This fund also has a low expense ratio of 0.04%. The minimum initial investment is only 1 share. If you're enjoying this video, don't forget to poke the like button. Our next fund is the Vanguard Russell 2000 ETF, ticker VTWO. This is a great choice for those who wish to invest in small cap companies because this fund tracks the performance of an index that measures the investment return of small capitalization stocks in the United States. Small cap companies are companies with a market value between $300 million and $2 billion. These are normally young companies which are growing. They can oftentimes beat the large cap companies due to growth, but they're generally considered riskier since they're oftentimes more volatile. The types of companies that make up this fund are consumer discretionary companies, healthcare companies, industrial businesses. This fund has a slightly higher expense ratio of 0.1%, which is an excellent value considering this fund offers exposure to the companies with the most growth potential. The minimum initial investment is only 1 share. Now we're going to talk about the Vanguard Total Stock Market ETF, ticker VTI. This fund is a single index fund, ETF, that invests in the total US stock market. It is made up of large, mid, and small cap companies proportional to the broader market, with an expense ratio of 0.03%. This is another low-cost fund that for those investors that want to invest in only one fund that tracks the total stock market, this is a great option for a total US stock market ETF, especially if you're trying to mirror the makeup of the portfolio used to come up with the 4% rule for retirement. The minimum initial investment is only 1 share. If you want to learn more about the 4% rule for retirement, you can check out my video, How Much Money Do You Need to Retire Early? I'll link to it above and in the show notes below. The next index fund we'll talk about is the Vanguard Real Estate ETF, ticker VNQ. If you're interested in investing in real estate, then this might be a great investment for you. This investment tracks the MSCI US Investable Market Real Estate 2550 Index, which widely tracks the US real estate market. The fund consists of mostly REITs that own operating income producing real estate. It also includes a few real estate management and development companies. This is great for people who are interested in investing in real estate, but they don't want to own an actual property. If you decide to invest in REITs, I would check with your accountant or CPA, discuss how it could impact your taxes. REITs are taxed a little different due to the way they're structured. This is not a problem. I would just recommend having that discussion prior to purchasing. And I know some people choose to purchase REITs in their IRAs or Roth IRAs to limit the taxable events. The minimum initial investment is only 1 share. The next fund is an excellent choice for dividend investors. It's called the iShares Core High Dividend ETF. It's ticker HDV. This fund tracks an index that is made up of 75 US stocks that pay relatively high dividends. As you might imagine, it targets dividend stocks that historically haven't been too volatile, but also issues high dividend yields. This might be a good choice for investors who are more risk adverse. Its top holdings include several energy stocks and big pharmaceutical stocks. This fund has a relatively low expense ratio of 0.08%. The current dividend yield stands at 3.56%. This is a great way to get a good dividend yield, but spreading out the risk instead of investing in just a couple of dividend stocks. The minimum initial investment is only 1 share. Most people, including myself, invest in dividend stocks and/or funds for the dividend yield, which is the cash flow that it produces and compounds when reinvested. Of course, having strong growth returns are important, especially when comparing funds to one another. But I always think of growth on top of the dividends as just the cherry on top. The next fund we're going to talk about is the Fidelity Zero Large Cap Index, ticker FNILX. This fund tracks an index of just over 500 US large cap stocks. It performs in a similar fashion to the S&P 500 index fund. However, as you might have noticed, it does not have S&P 500 in the name. The reason for this is the fund is not an official S&P 500 index fund, which means that it avoids paying expensive licensing fees to the S&P Global. The S&P Global is the index parent company. This fund tracks the Fidelity US Large Cap Index as its point of reference. This is a great investment for beginner investors because there is no minimum investment amount. The performance of this fund in 2020 beat the S&P 500's total return of 18.4% for the same time frame. The zero in the fund's names is a reference to the fact that the expense ratio for this fund is 0. A 0 expense ratio is huge because depending on what fund you're looking at, expense ratios are anywhere from 0.02 to 0.1, or sometimes even more, which detracts from your earnings. Finding a 0 expense ratio is rare and definitely gives this fund a leg up when comparing to others. If you want to learn how expense ratios, fees, and costs can kill your returns over time, then watch this video right here.